Okay, by my reckoning, it's 11 o'clock, so we should get going because we've got a lot to get through. So, as usual, I've got some news to cover, and then we've got the latest of our panel sessions. So, we're going to be really focusing on UK small and mid-sized companies, both in the listed space and in the unlisted space. So, to help us do that, we've got George Ensor from River UK Microcap, Haresh Vazirani of Patra Private Equity, and Mark Nisnik of Artemis UK Future Leaders. So some news first, three things that I've pulled out here, you can see there. We're going to start with CQS Natural Resources Growth and Income. There's the chart, there's the discount chart. Obviously, the discount's been heavily influenced by what has been going on with Saba, and there's a sort of long Saba saga going on here. And it's down at the moment to about 5.8%. Back in February, we had the vote to decide on whether people wanted to back Saba's proposals or not, and they pretty much universally rejected it. So of the people that weren't Saba, 98.6% of the votes were cast against the proposals. And we thought, that's it, done. But within a week, it had come back saying, we're going to call another vote, we're going to propose open-ending the trust. We argued strongly that it didn't make any sense because the whole point of it is it invests in relatively smaller things that sit much better in a closed-in structure. And then a few weeks later, 4th of March, they said, we've withdrawn this requisition because we're having constructive discussions with the board. And this is really the outcome of those, I guess. So a couple of days ago, they announced a 100% tender offer. The price you get for that will be based on creating a realisation pool. So basically, you'll just carve off a slice of the assets and then turn those into cash. If more than 60% of the shares are tendered, then the board will propose a liquidation instead. We'll come back to that. And they think that once they create a realisation pool, they can turn it into cash by September. But obviously, it depends on what's going on with the markets. So, to try and keep shareholders sweet, because they obviously want the thing to keep going, they're sort of tweaking the structure a bit. So the first is a really aggressive enhanced dividend policy. So 2% of NAV per quarter, 8% a year. Personally, I think that's a bit much. I think you can easily imagine that you'd be giving out a lot of the returns that you make as dividend. Obviously, investors can choose to reinvest those, and maybe if there was an easier reinvestment mechanism, then that would make a bit more sense. But nevertheless, that is the plan. And there are some investors that will love this and come flocking for the yield. They're cutting the management fee, which sort of makes sense anyway. So it was a tiered fee. That's just going to be a flat fee of 1% on NAV. They could have made it on market cap. That would have made me a little bit happier, but still, that's a step in the right direction. And there will be continuation votes in 2028 and then every 2 years thereafter. And this plays to what the board has been saying, is that really this thing needs time. It needs time without the distraction of being attacked every 5 minutes by Saba to just focus on making money for shareholders. And so part of the deal they've done is that Saba's agreed to vote in favour, obviously, tender all of its shares, and then commit not to try and interfere in the running of the trust until after the AGM in 2028. And obviously, that's helpful, and we'd like to see them go and disappear, but that might be wishful thinking. So this is where the trust sits relative to its peer group. What I've done there is sorted it by 5-year NAV returns, and you can see that it is the best performing trust in its sector over that period. But if you look at the 10-year numbers, it's also second there to just BlackRock World Mining. And a lot of investors think of it as being very complementary to holding BlackRock World Mining, because BlackRock World Mining holds the big stuff generally and CQS holds the smaller stuff. And when the mining sector gets going, which it definitely isn't at the moment, then you can get outperformance from the CQS type stuff. And so it's good to have a vehicle that represents that. This is the data that it put in its announcement. So one of the things the boards are trying to stress is that the long terms of this are actually long-term returns of this are actually quite good. Generally, you can see there in all the numbers up to 3 years, and that the shorter term has been much more difficult. And that comes back to the concerns about US slowdown, weak China demand, that sort of stuff. But the managers keep stressing that in this environment where everybody's been just very negative about commodities, there hasn't been an awful lot of investment in new supply. And so because as you mine, eventually the stuff runs out, that is sort of leading to a kind of shrinkage of supply, which means that when demand does pick up, you can get quite a strong acceleration of prices. So normally I'd say you've got to tender off. It makes sense to tender some of your shares. You can always buy back in again. If you do tender your shares this time round, there's a real risk that you won't be able to buy back in again, that the trust will have disappeared. And if you want to play the recovery theme, which could be quite spectacular when it happens, there just won't be a vehicle available to do that, or it won't be available in the vehicle available in the listed market. And these things work better in the listed market because they're small cap. And I'm sure lots of our panelists today would agree that small caps sit better in closed-end vehicles. So I am kind of pleading with people really to stick by it and not tender your shares. And yes, there may be a small hit if the discount winds a little bit afterwards. But if the recovery happens and the NAV goes shooting up, that will just be minuscule by comparison. So stick with it. RM Infrastructure Income has been winding down for a little while already. They've handed back £17.5 million so far. They've got a new tender offer on the table, £15 to £20 million worth. It's going to be based on the NAV as at tomorrow, and they reckon they'll have the cash back in your hands by the end of June. The realisation process that has been going on has been overseen by the manager, but there's also a three-strong board that are sort of sitting on top of what they're doing. By the time you get to the sort of end of April, they had cash and 17 loans left worth about £70 million. But the weighted average life of those loans is now less than a year. So the objective that they've got is to try and return most of the money by the end of this year. If you just let the loans run off and the lenders are able to repay, then I don't see any reason why that shouldn't happen. The manager gets a decent fee to do the job and a decent incentive fee if it can get it done reasonably quickly and achieve a result that's actually reasonably close to NAV. So that's tick, tick, tick. The board, though, are saying we're doing an awful lot more work than we were. So board members are now gone on to the boards of two borrowers rather, where they've ended up owning substantial equity positions in these because of the problems with them repaying the debt. They've got a lot more involved in meeting the borrowers, and they reckon that time is only going to increase from now on. So what they're asking for is 0.5% of all the money that's going to get distributed to shareholders, including this tender. So 80 million quid, about 400 grand in total between those three board members. I'm not sure in my mind whether I think that's a bit overly generous. I understand that you want to get paid for doing a bit more work. I'd sort of prefer it was based on the time done rather than as a percentage of NAV, but there we are. They have talked to shareholders about it. Apparently the shareholders are happy. So unless that's not true, I think it's just going to go rattling through. Lastly from me, just wanted to flag that we have got an IPO which sort of sits in the sector. It's a very similar thing to Yellowcake, which you'll probably know about, is a sort of play in uranium. So all it does is hold physical uranium. This one is a play on cobalt, and all it's going to do is hold physical cobalt. Whether this is the best way of doing it, I'm a bit dubious. You can see there it's raising $230 million. That's the target. There's 10 million quid's worth, dollars worth of fundraising expenses that go out of that immediately. They then buy a chunk of cobalt with it. And the money, the difference between the net amount that they've got and the 200 million there is to cover the fees of storing that and paying the directors and paying everything else. There's some really chunky fees in there. The company's going to employ a chief executive and a chief financial officer. They're getting paid 330,000 a year and 300,000 a year, respectively. Plus, the directors are getting pretty high in fees. And from what I can see, all they're going to be doing is sitting on a very passive fund that isn't doing anything other than making sure the Cobalt is sitting there in storage. And I don't really understand why the things are being so generous. But if you like it, and the Cobalt story is a good one, and it's had sold out in the prospectus, and there is a way of playing that through a retail book offer, which is this new vehicle that's been set up to let retail investors access issues. There's a whole link on our website. Whatever you do, as we always say with these things, there's a link to the prospectus. I know it's enormous, but do try and have a read through it. Take particular attention to the risk warnings and things, because obviously they are relevant. And there's a whole thing going on with Glencore, who they're buying the Cobalt off and then have arrangements to sell it back to. So, say, read the fine print. I think it probably will get away, and it'll be good to have an IPO, I guess, but wouldn't be the sort of thing that I would back at launch.